So good evening, guys. Kindly just confirm if you can see my screen and you can hear my voice clearly.
Yeah, good evening.
Good evening.
Good
Okay,
evening,
good.
sir.
Good evening, fine.
Yes, sir.
All right. Okay, good. So let's start our class for today. Um, so last week Tuesday, we started with conceptual framework last week Tuesday, and in doing that, I made you understand that conceptual framework majorly sorry. Okay, so I made you understand that conceptual framework is the tool that is used to develop accounting standard. And I told you that it can constitute the foundation of reporting itself. And we looked at some advantages and disadvantages of conceptual framework. Some advantages like the fact that it now makes development of accounting standard to be coherent and standardized. And also, there would no longer be political interference. And also, users will understand that reporting or accounting practice are based on a common ideology. And it can also help in the treatment of usual transactions. We looked at some advantages as well. And we also went ahead to look at the purpose of the conceptual framework. And in ascertaining the purpose, we said we should look at the users or the people that will use this conceptual framework. Then their use case would represent the purpose. From the IASB, who uses the conceptual framework to develop accounting standard, and who also use it in the harmonization and convergence of international regulations and accounting, and also the national standard setters, also the preparers, then users, then auditors, then the IFRS interpretation committee as well is useful to those ones too. And we finally mentioned that if there is a conflict between the conceptual framework and the accounting standard, I mentioned to you that the accounting standard will override. So the specific requirement of that accounting standard will override. Then we looked at some quizzes just to be sure that you were following. Then we went on to the content of the conceptual framework. And for this content, I told you that the conceptual framework we are looking at is the 2018 conceptual framework. And this 2018 conceptual framework has eight chapters now, 8 chapters. So last week we looked at chapter 1 and chapter 2. Today we are going to finish the remaining. And that is majorly what we want to cover today. Hopefully, the earlier we finish that, the earlier we go. For the chapter 1, we looked at the objective of general purpose financial reporting. And also in chapter 2, we consider the qualitative characteristics of a useful financial information. So for the chapter 1, I explained that the objective of a financial report, according to this conceptual framework, is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So the key issues we discussed here, even though it's advisable to know this objective by heart, is they won't ask you in the exam. The examiner will not ask at this level. So what I can ask you is something around financial information. We mentioned that this financial information are majorly economic resources of the entity, which are the assets of the entity. They are the claims against the entity, which are the liability of the entity, and also changes in these economic resources and claims, which are income and expenses. And we also mentioned that these financial information are prepared on an accrual basis. And when we say accrual basis, it means that income are recognized when they are earned and not when cash is received. And expenses are recognized when they are incurred and not when cash is paid. We explained that in detail last week. Then we went on to the fact that reporting entity, that we're going to look at that today. That's the first thing we're going to look at today. So we'll get there. And this information, you said, is provided to existing and potential investors, lenders, and other creditors. We explained that the reason why it's just those three is because these guys are the people that provide financial resources to the entity. Without them, the company might have even died. Okay, so they are very key. So they are the primary users. And we also discussed their information need also. Then we went on to chapter 2. We looked at some quizzes, which we did well on. Then we went on to chapter 2 that talks about the qualitative characteristics of a useful financial information. We talked about the fundamental and the enhancing. Fundamental makes it useful. The enhancing makes it more useful. Then fundamental, there are relevance and faithful representation. For relevance, it means that the information must have predictive value and confirmatory value. I explained it in detail. And we also discussed how information can have predictive value, from providing comparative information to providing information on one-off material items, to providing information on non-current asset held for sale, to providing information on discontinued operations. All these add to predictability of the financial information. So users can be able to predict using that. We discussed this in detail last week. Then relevance is highly affected by materiality. We explain what materiality is. Materiality of an item can affect the relevance of the entire financial information. All these we looked at last week. Then we went on to faithful representation, which is simply saying that ensure that whatever you are presenting actually represents the underlying transaction. It represents your economic activities. And the way to do that is to ensure that your information is complete, neutral, and free from error. On free from error, we talked about prudence. Prudence, because when you're prudent, you are not going to be biased. When you're prudent, you ensure that you do not overstate your assets and income, and you do not understate your liabilities and expense. Prudence is a new term. In this 2018 conceptual framework, it was removed in the previous conceptual framework of 2010. As we continue to learn corporate reporting and accounting standard, we are going to meet a lot of scenarios that empower prudence. We'll be talking about concepts that really makes accountant prudence. One of them is impairment of financial assets. The core idea behind impairment is just to ensure that you are not overstating your assets. You're not overstating your trade receivables, for example. So all of these are, I mean, they are ideas that are gotten from prudence. Then we looked at free from error. And yeah, I told you that this does not mean that our figures are accurate. They are not. And the underlying concept I introduced here was measurement uncertainty, and which is a principle that states that our figures are based on estimate and judgment and model. So they are not based on exact depiction. So entity must ensure that whenever there is high level of measurement uncertainty, they disclose it, they let user know. That is also about free from error. Okay, so that was faithful representation. We explained all of that. We also explained to you substance over form, which means economic substance over legal form. I gave you examples like when you lease a building, even though you are not the owner, you still keep it in your books because the economic reality is the fact that you are using the asset to make money. And whenever you have income in your books, there has to be something that is generating that income. You see that thing generating that income, you need to show it in your books, right? That's economic substance. We looked at when you sell an asset to another party and you are still using the asset. You sold asset to somebody and you are using it. You cannot recognize that kind of transaction as sales. In fact, if the person has paid you The money you received from that person, you recognize that also as a loan. That is economic substance over legal form. And I also give you an example of if you give your staff a loan, for example, staff loan, and you don't charge interest, those staff are not paying interest. So even though they are not paying interest, for you to report in accordance with economic substance, you must recognize interest income. Why? Because in the open market, they will charge the staff. If you go and borrow from anywhere, the staff will pay interest. So in order to show the economic transaction, the economic substance of that transaction, you need to still recognize interest income in your books, even though the staff is not actually paying. Yeah, so we also looked at the enhancing characteristics. Then we went on to some quizzes that were actually tough, and that was where we stopped last week. So before I start the class for today, do you have any question for me? Do you have any question for me? Okay, no questions. Now, so I want to believe that you have read what we did last week. I hope you have read it.
Yes,
So
sir.
by permission, yeah, go ahead, please. I thought somebody called me. Okay, so by my estimation, this is our third week of class, and we are going to 17 weeks. We actually don't have so much time, so we would be efficient with our timing. However, the bulk of the work stops on your table. That's the reality. We will teach you, we will guide you, but if you don't read all of these things, is not going to do you so much good. And as we are teaching you these things, we are sending you recordings, we are sending you notes, we are sending you a lot of materials. The easiest way that you can make life easy for yourself is on a weekly basis, you must ensure that you read these things. If you are not reading it, it will be too cumbersome and to be challenging for you later on. So early in the diet like this is the best. And perhaps in the first 10 weeks of our class, that is the easiest time to read, because at that point you can read under no pressure. By the time the exam is getting closer, you'll be reading under pressure, which is not so good. So try to read. Some of you might be reading already, but we'll find out very soon. So today we'll start from chapter 3. And chapter 3 talks about financial statements and the reporting entity. So two things we are looking at here. First, chapter 3 is looking at the objective of and scope of financial statements, which is a repetition of chapter 1. This is a repetition of chapter 1. Chapter 1 talks about the objective of a financial report. So it's still the same thing, which is to provide information about asset liabilities, what we have actually talked about. So I won't repeat this. It's just the same thing. Now, the next one is the reporting entity. The reporting entity. Now, when we say a reporting entity, remember the financial information we are providing it about a reporting entity. Now, this reporting entity in question is an entity that is required or that chooses to prepare financial statements. So when we say an entity is required to, that means by regulation, just like entities that are listed on the stock market, those ones are required. It's compulsory that they have to prepare a financial report. While there are some entities that just choose to, like most of these limited liability that are not really quoted, right? That maybe only 2 or 3 people own it, or maybe a sole proprietorship business, or maybe a partnership business, right? All of those people too, when preparing their account or reports, they comply with IFRS, but it's not required. They just choose to, okay? And also, a reporting entity can be a single entity. Can be a single entity. A single entity, net worth now is a single entity. GT Bank is a single entity. Diamond Bank, the defunct one, is a single entity. Just name any organization you know is a single entity. And it could be also be a portion of an entity. So a portion of an entity, then you'll be looking at maybe a branch of an entity. That's a portion. That can also be a reporting entity. We're going to teach you IFRS 8 on operating segments. You will see that we prepare report for a portion of an entity also. So it can be termed as a reporting entity as well. And it could be more than one entity. That's a group of entity. Okay, that's also a reporting entity. So from here, you will see that a reporting entity can be an entity that chooses or that is required to prepare financial statements. It could be a portion of an entity. It could be a single entity or more than one entity. And a reporting entity is not necessarily a legal entity. I think I've mentioned that indirectly now. Like it doesn't have to be a limited, it doesn't have to be a company. It could just be a one-man business, a sole proprietorship business, or a partnership business, or an enterprise, so to say. So it doesn't have to be a legal, it doesn't have to be a company, right? So that's a reporting entity according to the conceptual framework. That goes to show that any entity per se can actually provide financial information to users. Any entity. That's the meaning, that's what this guy is saying here. Then the second one here is the reporting period. And this reporting period here is majorly the current period. We are looking at a current period and also the immediately preceding period. That is the comparative period, right? And in some instances, under some instances, they can provide some forecast is maybe forward-looking information, right? But when we talk about reporting period under the conceptual framework, reporting period constitutes current period or the previous immediately preceding period. That is reporting period. Then still under chapter 3, it talks about perspective adopted in financial statements and the going concern assumption. So here, just saying that when we are preparing our financial information, we are preparing it from the perspective of the entity, not from the perspective of investor or analyst. Is majorly what this is talking about is just ensure that you are not biased, ensure that you are neutral. Okay, don't say because some analysts have said that you make so much profits, you are now preparing your financial statement from their perspective. No. Information or financial statement is prepared from the perspective of the reporting entity, right? And majorly that's what it's saying. And again, going concern assumption here is majorly is talking about the entity. Information is prepared on the assumption that the entity will continue to operate into the foreseeable future, right? So that's what this is talking about. And it talked about consolidated and unconsolidated financial statements. So this is just saying that when you have a group of entities, this chapter 3 is saying that it's better to prepare consolidated information. Now, consolidated information provide useful information to user than just preparing your own alone. So if you have subsidiaries, for example, now, you need to prepare group accounts. That provides more information. Okay, that's chapter 3. ICANN has never asked this before, and I don't see them asking it for corporate reporting. So you can just have it and know it, know what reporting entity is, reporting period and perspective. Just understand, these are things you should know that can help you in answering other questions, but nothing is coming out from there. So chapter 4, this talks about elements of financial statements. So majorly in this class, what we are learning to prepare is annual report, right? So in an annual report, there is financial statement, and there is other information there. So all of that we'll look at. However, for the financial statements, there are key elements and that's everything about the financial statement, those key elements. And these key elements are 5. we have the assets, we have the liabilities, we have the equity, income, and expenses. Those are the 5 key elements of a financial statement. So majorly, you just need to understand what each of these items represents. Not necessarily coming this definition, but understand it inherently. Like looking at this asset now, we said an asset is a present economic resource, right? We have met something like this before under chapter 1, when we're talking about the financial information provided. One of them is economic resource, and we've mentioned that is an asset, right? So it's coming here again when conceptual framework wanted to define an asset. He said it's a present economic resource. You see, the present here means that the entity has already acquired it. It's present, is here already. You cannot say you have an asset and the asset is nowhere to be found. You must have acquired it. So it's present economic resource. So we'll look at what an economic resource is, but for anything to be an asset, it must be an economic resource. And when you say you have an economic resource, importantly is you must control it. Controlled by the entity as a result of past events. Control is so important here that beyond having a resource, you must control that resource. If you don't control that resource, then maybe probably you own it. Ownership doesn't necessarily mean control. Control is what I was referring to when I was explaining economic substance. So control means that you are the one that is obtaining economic benefit from the asset, or the economic benefit from the asset is flowing to you directly. Then you control the asset. If it's not flowing to you, you don't control it. Okay. And when we say economic resource, what we are talking about is, we are saying is a right that has the potential to produce economic benefit. So really anything that is bringing economic benefit to you is an economic resource. Anything at all. In as much as that thing is making money for you. So when we say economic benefit, is either movement of cash, inflow of cash, is either increase in your assets, is either decrease in your liabilities, it's a lot of them. I mean, generally, anything that makes money for you is an economic resource. And when it is an economic resource, it is an asset. So at your level now, you should not be seeing an asset as something that you must necessarily see and touch. No, right? You don't have to. You don't have to see it. So if you buy shares, for example, and it's bringing in dividend for you, it's an economic resource. If you have Bitcoin and the value is going up, it's bringing money to you, it's an economic resource. Just name it, anything that is, in as much as that thing is just there and is bringing money to you, is an economic resource. Then it becomes your asset if you control it. That means all the money that is generating is coming to you, then you control it. So ownership has nothing to do with definition of assets. We don't deal with legal form. Ownership is totally ignored in reporting. What we are concerned about is the economic substance. What we are concerned about is the control. Who has control? Who is making the money? And that's so assets, there are numerous examples. Numerous. I mean, the popular one furniture and fittings, land, building. Is beyond that. Think of whatever that is making money for you. So at your level, they can give you any sort of scenario. Just know that, is this thing making money for you? And is that money your own? Then it's an asset. That thing is an asset. So liability is a present obligation, right? So present here also means that the obligation already exists. The present obligation of the entity to transfer economic resource as a result of past event. So the key point here is this: the obligation exists. There is an obligation, and that obligation requires this to that your resource, I mean, that is making money for you. You have to, if you are required to transfer it, we have to transfer it as a result of past events. So meaning that the transaction has occurred in the past, but you have an obligation to transfer economic resource, then you have a liability. But you see, this obligation, you need to understand that what it means is that it means that you have a duty or an obligation that you have no practical ability to avoid, quote and unquote. You have no practical ability to avoid. You cannot avoid it. If you can avoid it, it is not a liability. It is not an obligation. So it becomes an obligation according to this conceptual framework if you have no practical ability to avoid it. Then that means anywhere you are, anywhere you go, anything you do, anything you say, you will transfer that economic resource, right? Then we are talking about the liability. It's just like you purchase goods on credit. You have a trade payable. You will pay. There's nothing you can do. Or you borrowed somebody money from somebody. You would pay. There is nothing you can do. Another form of obligation that is not so obvious is something they call constructive obligation. So if an entity, for example, now, they come out publicly and say that they want to give all the youths in your local government, in where they reside, the local government they reside, they want to give them 50,000 each. They came out, they made that announcement. That is a constructive obligation. If you are the accountant of that company, quickly calculate the number of youths in that local government, multiply it by the 5,000, put it in their books as a liability, because they have no practical ability to avoid it, except if their goodwill is not valuable to them. And you know, you learn about goodwill now. When goodwill is damaged, it's gone. It's gone for the company. If goodwill is impaired, it cannot be reversed. So when you make a public statement, when you make a public announcement, you have already created a valid expectation in the mind of stakeholders that you are going to act in a certain manner. Should you not act like that, you make a mess of yourself. So there is a legal obligation, right? That if you don't do what you're supposed to do, if you don't act in that manner, they can sue you, right? But there's another one which is constructive. That's where an entity comes out to make a statement, right? And say it wants to act in this manner. Okay, beyond that is maybe an entity has some past practices of doing some things, maybe to the community or to its employees, right? It might not be written anywhere, but it's their practice. It's something they have been doing. It's an obligation already, and we need to recognize liability for that. So all of these things, you need to understand it, because beyond the conventional examples you know of liability, when you see a transaction, you should be able to interpret in a way that, is there an obligation? Is there a duty that we cannot avoid? And we have to transfer economic resource. Then that particular transaction in question, there is a liability involved. And that's a liability. The next is an equity. And when we say equity, the conceptual framework states that equity is the residual interest in the asset of an entity after deducting all its liabilities. Residual interest. This is the core word here. Residual interest in the asset. So when you have interest in something, reporting wise, it means that you are a part owner of that thing. Reporting wise, right? When you have interest, I'm not saying you have interest in a girl you like her. No, that's not what we're talking about here. For reporting, we are talking about you have ownership interest, is what we are looking at here. So, right? Or probably from that thing, you are getting something is flowing to you, more like cash, you know. So whenever you have an interest in an asset, or maybe in an entity generally, and your interest is residual. When we say residual, it means that it is you that they consider last when they want to pay benefits. It's your interest they consider last. Then that your interest, we call it equity. Equity is an equity. So the popular example of equity we know is ordinary shares, ordinary share capital. And the reason why they are equity is because for ordinary share capital, whenever they are paying returns, they are the one that gets dividend last. They will have paid every other person They will have paid employees, they will have paid governments, they will have paid creditors, they will have paid everybody. Is the retained profit, whatever money is remaining, they're okay, let's pay dividend. Even on liquidation, if the company liquidates and shuts down and they are selling the asset to settle people, it's still these guys that they settle last. Okay, so popularly is ordinary shares, But you see, some transaction can be structured and called any name, right? Whatever name they call that transaction, what is important is that if your interest is residual, then you are an equity holder. So there's always arguments around preference shares. Some people will say preference shares is liability. Some will say preference shares is equity. We should not argue as professional. Just ask, can I see the contract? Or what's the substance of this transaction? When they are paying returns, did they give you priority? Are you paid before every other person? If the answer is no, then it's equity. That's just what we want to know. And it has already been streamlined. So there are some preference shares they call redeemable preference shares, while there are some they call irredeemable preference shares. We will get to when we get to financial instruments. But I'm just fast forwarding knowledge. So when we say redeemable, redeemable means that at a specified date, those preference shares paid back their money. And usually those preference shares are always paid periodic interest, right? So in that case now, those ones are going to be, they are not equity because their interest is not residual. But the irredeemable guys, the irredeemable preference shares, those ones are always equity. You understand it better. But what I want you to know today is that when you have ownership interest in an asset, or when you are getting some kind of return from an entity, and it's you that they consider last, then you are an equity holder. Okay. Then the next one is income. So income is an increase in assets, decrease in liability that results in increase in equity, other than those relating to contributions from holders of equity claim. Meaning that whenever your asset increases, that is an income. Whenever your asset increases, that is an income. So I'm sure you're already thinking of increase in assets being evaluation gain or whatever. Yes, evaluation gain, it's an increase in assets. But again, by the time you enhances your assets and you make revenue from that, that's an increase in assets too, beyond just evaluation gain. All those are income, whether revenue or evaluation gain, they are income. Or if your liability should decrease, that is an income. It's just like somebody that you owe 50,000 naira. The guy just suddenly says that don't pay that 50,000 naira again. He forgives you of that loan. That's a decrease in liability. When your liability decreases, by the time you debit that liability to cancel it out, you credit an income. Okay? It's income when your liability decreases, right? So, and you see, these two guys, increase in assets, decrease in liability, they will definitely result in an increase in equity. So when equity increases, okay, you see, conventionally, there are two things that can increase equity. It's either you are bringing in more money, more capital, right? That increases your equity, or you're making profit. Or you're making profit. So that's why this definition quickly clarified that this increase in equity is other than those relating to contributions from holders of equity claim, meaning that this increase in equity we are talking about here is not bringing in more money. It is not additional capital. So they made it clear. Therefore, this increase in equity we are talking about here is profit or gain. It's indeed profit. So when we talk about income, additional capital is not income, of course, right? So increase in assets, either revenue or gains, decrease in liabilities, whatever way your liability decreases, is always an income. That will be the corresponding leg, is an income. Does that you need to identify that income is huge, income is bigger. Don't see income as revenue. Income is bigger than revenue. revenue is just a portion of income. So revenue is just the money you make from your primary line of operations. Primary. So if you are into agriculture now, and you're into poultry, doing all of those, making money from that, that's revenue. You can make money from other means. Maybe you have some side hustle that you're making money from. Maybe you have some properties. Maybe you are doing car rental by the side. Those other side business that can also make money for you are other income that are not your primary line. Or maybe another one is if you are receiving rent, or somebody gives you a discount, or maybe there's a revaluation gain. Those are income and they are not revenue. So revenue is big. Income is bigger than revenue. So income is increase in assets, which could be revenue and other income, decrease in liabilities, and also increase in equity, mostly profit, right? Then, um, then expenses. Expenses is just the reverse of income. So expenses majorly will be looking at decrease in assets, increase in liabilities that results in decrease in equity, other than those relating to distributions to equity claims, right? So the reverse of income is expense, right? So what I just need you to note here is that this decrease in equity, you see, two things can decrease your equity. Is either you are making losses or you are paying dividend. Okay. So that's why they quickly clarify that this decrease in equity is other than those relating to distributions to holders of equity claim, which is dividend. Dividend is not an expense. Dividend is an appropriation of profit. Dividend is a share of profit. That is not an expense. Okay. So the decrease in equity here we are talking about are losses majorly. Okay, so that's the core of this definition. So most of the things I'm saying, I've actually taken my time to explain it further down here, just to help your understanding. So you can just look through it if you are reading. All those explanations, I've explained everything. This income that I was explaining, revenue, other income, everything is itemized there for you. Okay, so yeah, I've been talking for almost yeah, over 30 minutes now. It's time for you guys to contribute. So you can unmute now. Yes, you can unmute now. So let's answer these questions. The first one states that in accordance with the International Accounting Standard Board's conceptual framework for financial reporting, what is the definition of income? So I'm not going to read it. Can you just read it yourself and tell me the answer?
C.
C. Let's see. Let's see. So Matayo also said C. If you don't want to talk, I think it's going to be fun if you can just type your answer in the chat. So C, increase in asset, decrease in liabilities that result in increase in equity other than those relating to contributions from fantastic. Fantastic. That's correct. That's correct. So let's look at question 2. We said Greener PLC a patent for 20,000. The patent gives the company sole use of a particular manufacturing process, which will save 3,000 a year for the next 5 years. What element of financial statement is the patent? So, it will be more fun if every one of you type your answer. So let me see that. I think I have like 16 of you here. So we have like 10 people typing. So Okay, so we are thinking that is an asset. That's correct. Okay, and majorly is an asset because um there is a savings. It will save the company 3,000 a year for the next 5 years. So it's purely an asset for the fact that it saves the company money. So that will more like an inflow or savings, maybe decrease in liability or something like that. And also the company has the sole use of it. Okay, yeah, it has the sole use. So it even has control. So it qualifies as an asset. So that's correct. So I can see Timileyin Daminola and Fidel participated. Keep that up. Then the next one says that Ade Limited paid Wisebaba PLC 10,000 naira to set up a car repair shop on condition that priority treatment is given to cars from Ade. What element of financial statement is this 10,000 naira to Ade? So let's type our answer. Okay, similarly said is a liability. Can I have other opinions? Other opinions? Ayo said is a liability. Yeah, Motayo said is a liability. Liability. Yeah, Fidelis said is an expense. Good. Ayola said is a liability. Okay, so we are between liability and expense. Everybody is saying liability except Fidelis. Fidelis, you want to change your mind or you want to maintain your expense? Only said is an expense. Okay, so who is right? Is it the liability people or the expense people? Okay, so Fidelis is maintaining his expense. So let's look at it together. So yes, it's I was even thinking some of you will say assets. Wondering why you said it's a liability. It is not a liability. Ade PLC gave somebody money. So we are not saying what element is this to Ade? How is that a liability? It's liability, right? Yeah, somebody said equity. Yes, so yeah, so I will come to that
Equity.
also. So yeah. I hear you. So I would come to that. So let's already sign up mute. So let's already explain why liability is not the answer. Simply because there is no obligation here. Is not like we say Baba has Ade has an obligation to transfer. He has a present obligation to transfer. The guy has given, he just gave him money that take this money, go and set up a car repair shop. He just gave him money. Okay. And from what I'm seeing here, he didn't ask Wuse Baba to pay back. So for me, for Wuse Baba, it's just like a gift to Wuse Baba. As far as Wuse Baba is concerned, it's a gift to him. So again, I can see Zainab Damilola and yeah, my other friends saying that it is an equity. Okay, so an equity is a residual interest in the asset of an entity, right? So when you say interest means that you will be getting some kind of returns, right? From whatever profits they are making, you have an interest in the asset. Interest in assets. You'll be getting returns. And when the company even falls down, they will even consider you, though your interest is going to be considered last. So this one is not even residual. This guy is saying that they want Ade is saying that take this 10,000, go and use it for your business. So, but I want whenever I bring my car to your shop, I want you to give my car priority treatment. Like let me wash my car for free, something like it's didn't even say for free anyway. But he said they should give his car priority treatment. So it is not equity, right? He didn't say that, okay, whenever you make money, I will share part of your money. No, he's not sharing. He's just saying that give me priority treatment. So it is not equity, neither is it liability. Ade is not owing anybody money. Now let's come to expense. So Ade, as far as I'm concerned, he has experienced a decrease in assets because he has outflowed money. He gave somebody money, gave somebody a gift for whatever reason. So he has outflown. There's a decrease in assets here for him. So yes, there is nothing here saying it is not an expense. There is nothing that is saying it is not. For me, expense stands. But another item that can challenge expense here is assets, right? So assets is an increase in assets. Sorry. Asset is a present economic resource. An economic resource is a right that has the potential to generate economic benefit. So it's not generating any economic benefit here. So it is not an asset. So the clear answer here is expense. So Fidel and Oyin were the only two that were correct. Fantastic. Keep that up. So the next
So I can
one
ask a
here.
question, sir.
Yes, please. You can ask.
Now, as regards to the answer, this liability also it can be in form of a liability to Ade because is giving out.
Okay.
Because
Okay.
expense is in his book. Maybe he will charge it to the statement of profit and loss. But liability, he will charge it to the statement of financial position.
Okay, good. Okay, good. I like your question, right? If fine. So whenever you have given out, that one is not liability anymore. When you have given out. So liability is a present obligation to transfer economic resource. So you have a duty to pay money. You have a duty to do something. That is a liability. In this case now, is not, there's no anticipation to transfer. He has already given somebody money, right? So there is no liability here. So you see it now, if I. Okay, I want to believe that yes. So let's go to number 4. Truthful Limited provides a warranty with every car sold. What element of financial statement is the warranty? So you can tap your answer, please. Ayola liability, lawful liability, similar liability, fee liability, only liability. Okay, I mean, I think this one, everybody is correct. So, yeah, warranty, there is a clear liability there. There is a clear liability there. So, there's no story to that. Most warranties, it's a liability. Most warranty, right? It's a liability. Yeah, so you will learn more about this when you get to IS 37. So let's leave all those details to IS 37. Okay, so fantastic one, guys. Now let's look at chapter 5 of the conceptual framework. So this time, chapter 5 talks about recognition and derecognition. And here, recognition was defined as the process of capturing for inclusion in the statement of financial position or statement of profit or loss, whatever. So what is important is recognition is synonymous to what we call recording, right? The process of including an item in the books. So we'll be talking about a lot of recognition as we move on. So for asset and liability, you can only recognize an asset and liabilities in your books if they are relevant and if it will provide the user with faithful representation of the transaction. If you remember, that means the recognition criteria for asset generally now is that it must be relevant and it must provide users with faithful representation of the financial statement. So recognition criteria is just like the fundamental characteristics. So when you remember the fundamental characteristics, then we will know the recognition criteria for asset and liabilities according to the conceptual framework. Because relevance and faithful representation is the fundamental characteristics. So this one was just updated. It wasn't like this before in the old conceptual framework. So relevance and faithful representation are the recognition criteria. So before you can recognize asset or liability in your books, it must be relevant and it must faithfully represent the transaction. Then the recognition. The recognition is the opposite of recognition. While recognition is inclusion, the recognition is removal. So removing asset or liability. And the recognition criteria, before you can derecognize, the conceptual framework says that there must be loss of control of that asset and the entity no longer has the liability, has an obligation. That is, it has settled the obligation, it has paid money, right? So these are the two derecognition criteria. They can actually ask you this in the exam according to the conceptual framework. So these you have to know by heart for your exam. So that's that. Another thing I think you should note is this. You see that the recognition criteria refers to just asset and liabilities. The recognition criteria also consider just asset and liability. The reason is that when you have assets, then that is the only time when you can have income because it's asset that creates income. When you have liability, that is when there will be a creation of expenses. And your equity, according to the financial concept of capital, which we're going to get to, you see, generally equity or capital, to make it easier for you, is asset minus liability. In reporting, your capital is determined as your asset minus liability. So as soon as you have recognized your asset, automatically there will be recognition of income and equity in the end. The same thing for liability too. There would be resulting recognition of expense and equity. And also, that. So asset and liability determines the rest. So that's why they focused on that. So now when you have recognized these elements in the financial statements, then the amount at which you put them in the financial statement is what we termed measurement. The amount you put them in the financial statement, that is measurement. So there are majorly two measurement bases. Okay. When we say measurement, how much are you putting it in your books? So two measurement bases we are looking at, there is the historical cost and there is the current value. Historical costs and current value. So historical cost basically is how much you have acquired an asset or how much you originated a liability. So historical cost is saying that if this is 2024, for example, now, and you bought an asset in 2015, if the asset is still in existence and is still in your books, it's still the amount you bought it in 2015 or whenever you bought it, that you still keep it in your books till today. That's historical cost. And majorly to today, that is how we report our books at historical cost. The cost must be there, it doesn't change. So we bought something in 2015, for example, for 50,000, an asset. Today, it will still be in your books at 50,000. you can already visualize how irrelevant that can be. That can make our information to be, considering where we are finding ourselves now in Nigeria, where our currency is not stable. So you know that an asset you bought 50,000 in today's world now is going to be worth much more, right? If the asset is still in existence, right? So historical cost, that is what it is, and that's how we report as at today. Okay. Though recent standards are trying to move away from historical cost and trying to consider current value, which is the second measurement basis here in the conceptual framework. So current value, yes, you will initially recognize it at the amount you bought it or the money you borrowed, right? The amount you bought the asset. However, it will be updated for any change in economic environment. You update it. So that means when you buy an asset in 2015, if the asset is still in existence and in your books, it's going to be reflected in your books at the current price of today, right? At the current price of today. So that's what current value is looking at. So we use current value right now. You will see it as we move on that we use current value in a lot of these accounting standards today, right? And there are three scenarios in which you can use current value. Three scenarios. One is fair value. And fair value is used when you want to sell an asset. So if you bought an asset and now your intention is that you want to sell these assets, then if you are using current value in that case is going to be the fair value. I'm going to teach you this fair value as a separate topic very soon, maybe in the next 2-3 weeks, right? Or more, not 2-3 weeks, maybe the next 4 or 5 weeks. I'll teach you IFRS 13 on fair value measurement. You see that he defined it as the price that will be received to sell an asset or pay to transfer a liability in an orderly transaction, right? So this definition for me for now is not what is important because we are still going to look at it. What is important for me today is to understand that fair value is used, is under current value one. That's what I want you to know, is under current value. And it is used when you want to sell an asset, okay? Or probably when you want to settle a liability. That's the relevant value to use is the fair value. However, if you are continuing to use an asset, you want to use the asset for the foreseeable future or for a specified period of time, and probably you intend to sell it eventually, then you are considering value in use. Okay. For me, this definition for me today is not what is important because we are still going to teach you IS 36 on impairment, where I will critically explain to you how value in use is determined. But for today, I need you to understand that value in use is relevant when your intention is to continue to use an asset, right? You don't intend to sell it until after a long period of time. Fair value is used when you don't want to use it again. You want to sell it right away, like it's already in the market. In that, you are ready to release it immediately. Value in use is you are not intending to sell it today. You want to use it for a long time, then sell it ultimately, like maybe after you have finished using it. Then the final one, which is still under current value, is current costs. And this is synonymous to replacement cost. Is replacement cost. So this current cost is just okay. You want to replace an asset today. So how much is it today? So the amount you can buy that asset today is the current cost, right? So when we talk about current value itself is not something we use in itself. So it's either you are using fair value, which is the price you want to sell when you want to sell an asset, or value in use when you plan to continue to use an asset, or current cost when you want to replace an asset. So those are the relevant measurement basis. Okay, so then you can look through these ones. I just gave some further explanations on all of these things, which you can look at. So let's look at these quizzes before I continue. to chapter 7. Okay, this states that in accordance with the ISB's conceptual framework for financial reporting, which of the following is not a measurement basis of financial statements? A, current cost; B, present value; C, value in use; D, historical cost. So you can type your answer. We said present value. Okay, can see a gap. Said define present value. Okay, are your present value? Okay, so I know present value. So that's okay. You guys are correct. Then the second one, which of the following criticism does not apply to historical costs financial statements during a period of rising prices? Which of the following does not apply? So A, they are difficult to verify because transaction could have happened many years ago. B, they contain mixed value. Some items are at current value and some are out of date value. Which of the following does not apply during a period of rising prices? Does not apply when there is inflation. Okay. So C, they understate assets and overstate profits. Understate assets. Okay. D, they overstate gearing in the statement of financial position. Overstate gearing. Okay. So, I mean, this one is not as direct as the other one. So, but you can just put your answer on the chat. Let's see. So, Timilen is going for B. They contain mixed value. Ayola is going for B. And only B. Sign up B. Okay. So, why is okay? Only said D. Okay, good. I was wondering, I thought everybody was saying B. So let's look at D. They said they overstate gearing in the statement of financial position. When we say gearing, we are talking about your level of debt, right? So how does historical costs overstate gearing? Does it overstate gearing during period of inflation? Because it's historical cost now, because the value does not change, the value will be small. So since the value is small, it will now make the liability looks higher than the assets, because your assets will be recognized at the amount you have bought it for a long time. So I think they overstate gearing. So yes, they actually overstate gearing. So only D is not correct. So B, most of you said B. I said they contain mixed values. Some items are at current value and some, yes, so it's true. So depending on when you are buying the assets, okay, depending on when you are buying the assets. So, but this does not apply during rising inflation. Some are at current value, some are. So this is the only one that does not apply. Every other one, but wait though, they are difficult to verify because transaction could have happened many years ago. How does this A apply? Since they are difficult to verify. When you have bought something, you have bought it. So even I think A should be more of the answer than even B. So instead of, because since historical cost does not change. It's just when the price at which you have actually bought it for a long time. So anytime you want to verify, just go and check your receipts. Then you see your prices there. So A is more like the answer. Okay, that's a good one. So let's go to chapter 7. So we have looked at recognition, we have looked at measurements. Now, we want to look at presentation and disclosure. So here, what is relevant to us here is just that you just need to understand what this is saying is when you have your asset, income, and those other elements, liabilities, and the rest. So this chapter 7 is saying that you have to present them to users. You have to present them to users. And the way in which we present them to user is for us to present them in certain statements. Okay, hold on. So I have a question from Ayola. Said option D is still not clear. Please explain. Okay, so option D, yeah. So let me go back to this option D. So sorry, I have to go back. So this one, they said they overstate the gearing in the statement of financial position. So when we say gearing, you will learn gearing means the proportion of debt in your capital structure, or how much of liability are you using to finance your business. So it's usually debt over your, maybe debt plus equity, or it could be debt over your equity, or you're comparing your debt to your equity. So, or debt over total assets. So depending. So for clarity here, let's just see debt. Let's just see this gearing as debt over your total assets, right? So we are looking at the proportion of other people's money that you have used to finance your assets. So when you have a scenario where your asset is carried at historical costs, and is not reflecting the current is not reflecting current prices. And this question is saying during a period of rising prices. So when prices are rising, ordinarily historical costs, if it have reflected current prices, the value of the asset should go up. The value of the asset should go up. But since the value of assets are suppressed as a result of historical costs, right? Since the value of the asset are suppressed, so by the time you put, let's say your historical cost asset is 50 and your total debt is, let's say 20. Let's say 20. If you do 20 over 50, what would that give us? Is that not 10%? That's 40%. If you do, yeah. So that means your journey will be like 40%. However, if you had maintained your assets maybe at current prices, it was reflecting, your assets will not be 50. If you are reflected current price, it will be like maybe 100. Looking at Nigeria of today, the value will have gone up. You know how much you sell Corolla now? Corolla that I were buying, my first car was Corolla. I bought it 1.1 million. Imported. Clean. Now, Nigerian used, that is terrible, is over 4 million naira. So the current prices should have gone up. So let's say 100. So put 20 on 100. So your journey should be 20%. But because of historical cost, it will have overstated your journey. So this one actually apply. So that's why this is not the answer. Right? So again, this one too that we're thinking is the answer before also applies, because they contain mixed value. Some items are at current value. So because this one, depending on when you have bought your assets. So historical costs, if you bought the asset today, that's the historical cost today. The ones you bought last year, you will still be carrying it at the value of last year. So if you check the value of your PPE, it will be a combination of the assets you have, depending on when you have bought it. So this one does apply. So the only one that does not apply is that saying that you cannot verify it. You can verify it. You can actually do verify it. So Ayola, I'm not sure if I've answered your question. Okay, it's clear. Good. So chapter 7. So all I want to learn here is just how do we present those information? So he started with principles of presentation. So this one is not really so important to us, saying that, okay, you must ensure that when you're presenting your assets, you present asset and liabilities of similar nature together. And those ones that are not similar, you present them separately. Yeah, it's okay, but I don't see your examiner asking you that, but it's a point that you need to know that assets that are of similar nature, put them together, liability that are similar, put them together. So the ones that are not similar is what you should present separately. And also avoid unnecessary details in the financial statements. And also you should tailor financial statement to each entity. Don't use a standardized approach for everybody, which is what people do today anyways. They just use, because every framework wants the reports that you are presenting to be flexible. It should be tailored to the entity, but everybody just as preparing it the same way, probably just for simplicity, right? It's clear here that avoid a standardized approach. It says boilerplate. It's too, we want it to be flexible. IFRS is principle based, right? So, but that's okay. Yeah, beyond that is that presentation is just these three items that is relevant to us. One is the statement of profit or loss. Two is the statement of other comprehensive income. And three is recycling. So income and expenses, you present them in the statement of profit or loss. They also call the statement of financial position. So, and most of you know how it looks like. So we'll still, most of the standards we look at will be preparing these statements. And there's another statement called other comprehensive income. So other comprehensive income, IS1 says that is either you are preparing it as part of your statement of profit or loss. So that's why we call it statement of profit or loss and other comprehensive income. And you can also present your other comprehensive income separately and call it statement of other comprehensive income. What is important is that what goes to this other comprehensive income are majorly unrealized gains. Unrealized gains that are usually called economic advantage. Okay, just like there is a revaluation of assets, right? You revalue the assets and you made a gain. That is an unrealized gain because it can actually reverse. It can reverse. You can lose that money. Okay. The only one that IS 21, you might look at that, but I'm not sure we are going to look at that. So most now that these foreign if you have dollar, for example, now, if you have dollar and you had dollar when it was maybe 800 naira to a dollar, and you still have the dollar now, where it is almost 1,000, over 1,300. You have made a huge gain. So that one is not realized gain. No. That one is realized gain because we are talking about money. Money. So that one is money. It's realized immediately. Except, so since it's cash and cash equivalent, so you put that in income, you don't put that in other comprehensive income. So most items of other comprehensive income that we are going to be looking at in this class, I mean, for my own class, yeah, we'll look at revaluation gain. We'll look at actuarial loss or gain under IAS 19. We are going to look at return on plan assets, still under IAS 19. So majorly those, right? And when they teach you foreign subsidiary, then you'll be looking at exchange difference on translation of a foreign subsidiary. That is also under other comprehensive income. So all of these things we'll consider them as other comprehensive. But other comprehensive income and major, what goes there is changes in the value of assets, right? And that value, that changes is temporary in such a way that they can still reverse tomorrow. then that you can lose out. So we don't want to recognize such type of gain in our P or L because they are not readily available to our shareholders as dividend. We cannot be confident and tell somebody that we have made this so much money or this so much profit because they are unrealized gains. They can reverse and disappear tomorrow. So except when it has to do with money, like you have the money at hand, whether current, whether dollar, whatever, that one is realized because it's money. So every other one that is temporary, a temporary gain goes to other comprehensive income. Okay, so Prosper, you can go ahead with your question.
Okay, so I wanted to ask, like, when an asset is disposed, the profits from it, does it go to under comprehensive income or profit or loss account?
Oh, fantastic question. So the gain or loss on disposal of an asset, that one is the income you have made. That one is a clear realized gain. Is clearly realized, right? So that one, no question on that. In fact, that's not what recycling means, but recycling here means that all these unrealized gains we are talking about here, like you revalued your building now. Your building in your books initially was 20,000. You now revalued it. They told you that it is now worth 30,000. So you have made an economic advantage or economic gain of 10,000, which is temporary because you could check it tomorrow again and they say it's lower. So those are the type of ones that go to other comprehensive income. However, if you now sell that asset, if you sell that asset that year and you make money, then that gain, that unrealized gain becomes realized. It becomes realized. So when such happens, when an unrealized gain becomes realized, like revaluation surplus, now it can only become realized when you sell the asset. Then that is where recycling actually comes in. Recycling is just the process of transferring unrealized gains to your P&L when they become earned or realized. However, IS 16 stated that whenever revaluation gain becomes realized, you recycle them to retained earnings. You don't recycle them to statement of profit or loss. You recycle them to retained earnings. You earn them direct. I will teach you some part of that as a revision because it's your syllabus assume that you have actually done it before, but I'll still show you about that. But recycling is just when these unrealized gains that goes to OCI, when they become realized, then you need to transfer them from OCI to either your POL, so other P&L owner, you just put it as other income, or you take them to retain earnings, like in the case of revaluation gain, it goes to retain earnings. So that's that. So like that exchange difference on translation of a foreign subsidiary, for example, now, when you have a foreign subsidiary and you have to translate it to your presentation currency or reporting currency, there's always an exchange difference that goes to OCI. So that one too becomes realized when you sell or dispose that foreign subsidiary. So that one will be recycled to P&L. Okay. So for me, all this I'm saying will just help you understand most of the key concepts we are going to be talking about going forward. It's not like ICANN is going to specifically ask you stuff on these ones. I just need you to know that these are ways we present our financial information through the statement of profit or loss. And what goes to OCI are changes in value that are temporary, unrealized gains. And when these unrealized gains become realized, you need to recycle them back to either your POL or you are recycling them to your retained earnings. So, and I've told you the particular one that I recycle to retain earnings. I told you about the evaluation surplus or gain. That is mostly recycled to retain earnings. I will show you practically when we look at depreciation and amortization as a revision in this class. Finally is chapter 8, which talks about concept of capital and capital maintenance. So two things we want to look at here. First, we want to look at concept of capital, and second, we want to look at capital maintenance. In reporting, there are two concepts of capital. We have the financial concept of capital, and we have the physical concept of capital. Please listen up to me. The financial concept of capital is the concept of capital that we use till today, meaning how do we determine the value of our capital? And I've told you before in this class that today in reporting, the way we determine the value of capital is simply asset minus liability. So it considers capital as the monetary value of capital. After you have, of course, your asset, what you have used your capital is just your asset, then remove whatever it is you have borrowed. What is remaining is your capital. So financial concept of capital is as simple as your net asset. Okay, so it looks at capital from the monetary value. So this is what we use today. This is what is relevant in today's world. This is what we are using. But the conceptual framework states that we can also use physical concept of capital as well. It says we can use physical concept of capital as well. And physical concept of capital looks at capital from the angle of productive capacity or operating capability. What does that mean? It means the units that you can produce, whether per day or per month or per year, the units you can produce. So this doesn't look at money, but rather it looks at productive capacity. What can you produce? So why financial capital or financial concept of capital is saying I have 100 million capital, physical concept of capital will say that I can produce 50,000 units. That is capital, but we don't do this. Nobody does this. So that's the concept of capital. You can read up these things. Everything I've explained is what is here, right? So the next one is capital maintenance. Capital maintenance. So how can you maintain your capital? It's simple. You can maintain your capital when you have made profits. When you have made profit. So for the financial capital, financial concept of capital, so we're talking about financial capital maintenance. For the physical concept of capital, we're talking about physical capital maintenance. So financial concept of capital is you can maintain your capital under that when you have made profits or probably you have broken even. So it's quite straightforward. It's as straightforward as saying that at the beginning of the year, you had a capital of 10,000 naira. And at the end of the year, your capital is now 11,000. You have maintained your capital. And the difference of 1,000 is your profit. That's your profit. Or if your capital is 10,000 at the beginning and at the end it's still 10,000, you have also maintained your capital because you didn't deplete it. So that's financial concepts, capital maintenance. It's straightforward. However, for the physical, for this one, you have maintained your capital if you have increased your productive capacity. That is when you have maintained your capital. When you have increased your productive capacity. So let's make it very clear. You understand how physical capital maintenance is so important, which we don't use in period of inflation. When there is inflation, physical concept of capital will help you know whether you have actually made profit or not. Let's look at this thing together now. Look at this. I need you to focus on this. Remove your eyes from all of these other details, right? Because that's what I will explain with my mouth. So focus on this now. So opening, closing, right? This is an extract of a position statement. So this guy has inventory and his productive capacity is 100 items, right? So the financial for 100 is 500 naira. That's the cost of the inventory at the beginning. So at the beginning, that means each item will be like 5 naira. 5 naira. That's the cost. So since 100 item is 500 naira. However, at the end, the same 100 units is now 600 to produce. Okay. It's not 600 to produce. Ayola says that my screen or my internet is not good. I need another person to confirm so that maybe his internet or it could be that of Ayola's. So is my screen frozen? I need one person to just confirm yes or no.
That should be from
No,
my
sir.
own end.
Okay, so for Mayola. Okay. Okay, we're almost done. Okay. So now you see that at the end, the same 100 naira now is now costing 600 naira to buy. So that means there's inflation has already set in now. So it's like 6 naira per unit. I hope you understand what I'm saying. Inventory, I can do 100, but it cost me 500 at the beginning. At the end, the same 100 is costing me 600. Other net assets, whether PPE, any other asset, 1,000 at the beginning, 1,000 at the end. It didn't change. That means my total assets is 1,500 at the beginning. At the end, my total asset is 1,600. Okay. So my capital is 1.5. Of course, you know that assets must be equal to capital. If liability is 0, right? So everything balanced. Capital 1.5, my assets 1.5. At the end, assets 1.6, my capital 1.6. Okay, so let's focus on this capital now. Under financial capital maintenance, this guy will say he has maintained his capital. This guy will say he has maintained his capital. Why? Because look at the capital at the end, 1.6. At the beginning, 1.5. The difference of 100 naira is profit. So he has maintained his capital. So usually, this is how we prepare our accounts today. In today's world, this is what is obtainable. So that 100 naira profits, that is where they will pay tax, they will pay dividend, they will do all sorts with that 100 naira profit. But the fiscal maintenance guy will tell you that, see, what is happening here is this. Your 1,600, this your 1,600 is your capital at the end. You see, at the beginning, right? At the beginning here, this 1,500, if you want to produce 100 units, if you want to produce 100 units, how much do you need? If you want to produce 100 units. So this 1.5 at the beginning was sufficient to produce 100 units, right? This 1.5 was sufficient to produce 100 units. So this, by the time you remove other assets, 500 naira, at least you can produce your 100 units, 1,005. But here, other assets, this 1,600, yes, it will fund other, constitute other assets. And the excess of 600 naira is to still produce 100 units because prices has increased. So for physical will tell you that this 1,600 that you're having here at the end, it can only sustain, your productive capacity. Because if you don't have this 1.6, you will not be able to do 100 units. You will not be able to do 100 units. Because, for example, now, if you go and say, like the financial capital people, that 100 naira, let's say they distribute it as dividend. So that means this 1.6 will now come down to 1.5. So 100 has been tied down to other net assets. That means they will only have 500 naira for 100 units. And now that the price is now 6 naira per unit at the end, that means they will not be able to do 100. They will do less than 100. So physical capital people will say, hey, don't distribute that 100 naira. That 100 naira is just only sufficient for you to maintain your productive capacity. right? And that's why most companies find it difficult to succeed, especially if they are just starting up. If they don't look at their productive capacity, they will just say, we have made profit. They will not consider the effect of inflation. They will not consider that, can we maintain our productive capacity? Unfortunately, we don't prepare our accounts that way. The way we prepare our account is in line with that. It doesn't consider inflation. You just, you have your revenue, you have your costs, you get profits, deduct all your expense that you have incurred. Whatever profits you made, you have, nobody is looking at these profits. If I add it to my capital, what can I produce? Can I maintain what I can produce at the beginning? A lot of people don't do that, right? They don't consider that. So there is only one set of people in Nigeria that does that, which are my Igbo people. They don't, I mean, they have perfected that art. You can hardly find them run out of business. They don't spend their profit until maybe they have restocked. Is whatever is remaining, they will go and flex with, right? So I don't know whether I'm communicating, because
Yes,
if
sir.
I'm not okay, I'm communicating. So I just need
Very well,
somebody,
sir.
any of you. I need one person to say I am not communicating, because I'll be willing to go back. Okay, so if there is no one saying I'm not communicating, there's a question I want to show you here. Look at this question here. I intentionally did not solve it. Look at this question here. It said that X Limited commenced business on 1st January with a single item of inventory, which costs 10,000 naira, right? During the year, it sold the item for 14,000 cash. I said during the year, general inflation was 5%, but the inflation specific to the item was 10%. Calculate profits in each of the capital maintenance concepts. In each of the capital maintenance concepts. So let's start with financial capital maintenance. Let's start with that one. What will be our profit under financial capital maintenance? I need you to tell me what you get. Just type it. What will be our profit under financial capital maintenance? The cost is straightforward. Don't overthink it. Yeah, that's correct. Somebody has said it, 4,000 naira. So under financial concept of capital, sale, that one just looked at how much is my sales, 14,000. How much is my purchases, 10,000. He recognizes 4,000 naira as profits. Yeah, fantastic, Prosper. So that's the financial concept of capital. It's just sales minus costs, and that's it. Now, under physical concept of capital, how much is my profit? How much would that one recognize as profit? Under physical capital maintenance, how much will you recognize as profit? Okay, Ayola said 3,000. So I want to believe that you consider the inflation, because when you are preparing our account now, yes, our sales, Ayola, 3,000. So our sales is 14,000, right? Our cost is 10,000. But fiscal people will not just look at the historical cost. They will look at what is this cost today? And here they are telling me general inflation is 5%, specific is 10%. I won't use general inflation. General inflation is consumer price index, the total aggregate of prices, increase in general prices. I'm considering that item is 10%. So if I add 10%, 1.1 on 10,000, that would be 11,000. That means today, the cost is 11,000. So 10,000, there's an increase by 10%. because of inflation. So that means the cost of my purchases today is 11,000. Take that away from your sales, 14. That gives me 3,000. Fantastic. Ayola and Ayo. Good one. So under physical capital maintenance, my profit is going to be 3,000. Fantastic. Okay. If there's anyone that is not clear on that, please drag us back. I like to be dragged back in class. So I've shared this note with you guys. So there are some questions in skills that you should just ignore. Your own part, there was this question they asked in 2021. I would like you to look at it. Intentionally, I didn't put the solution there. So because I want you to attempt it. And there are some that I have the solution here, like these questions here. So just take your time to look at most of these things. Okay, so we are done with conceptual framework and we are done for today. Next week, we are going to be starting more of calculation in the name of IFRS 2 on share-based payments. Let's see how far we're going to go with that next week. So let's just keep moving. So over time, I would be exposing how to pass corporate reporting to you, but to allay fears and all of that, let's even do our first 7 to 10 weeks of class. Let's see that. And I will remind you what I did in my first class, the analysis I did to you for how to ensure that you don't fail corporate reporting. But just be sure that since you are part of network professionals, you won't fail corporate reporting. You won't. I can assure you that. So let's see how it goes. If there are no questions, I think we are good to go for today. Or is there any question?
Yeah, there's a question.
Please go ahead, Ifeanyi.
My question is as regard to the current value.
Okay. Go ahead.
The current value, can we liken it to revaluation?
Yes. It's similar to that. Okay. It's actually similar to that. But we don't consider that as part of current value, right? So reporting, let me explain that to you. So reporting is more of about intention. It's more intention. So when it comes to assets, right, there are three scenarios. Is either we are considering that you want to sell these assets, then the relevant value there would be fair value. You want to sell this asset, then you'll be using a fair value approach, or you want to continue to use these assets to the foreseeable future, then you'll be considering value in use, or you want to replace these assets, then you'll be considering the current costs. However, IS 16, when it was talking about measurement basis, IS 16 says that for IMO, is considering two measurement bases. Is considering the historical cost, which they call cost model. That one, it aligns strictly with historical costs. And there is another one called revaluation model. And for evaluation, that is where you are going to mark your assets to market at periodic period or at intervals, maybe every 2 to 3 years. So IS 16 is just, I mean, is a bit deviated from what this guy is saying here under current value, because revaluation is not fair value. It will only be fair value if your intention of revaluing is just maybe you want to sell the assets, then probably revaluation will not be fair value then. However, if your intention is to replace the assets, that's why you want to revalue and know what's the value of the asset today, then revaluation can be current costs. However, if your intention is that you want to continue to use this asset, then evaluation can be value in use. Okay, so that will now inform how you are going to revalue or get the value of your asset. So for me, I'll be very careful to tell you that the valuation is the same thing as current value. It's not. It's not, because it depends on your intention. So just let's leave revaluation as that, okay, you are just revaluing your assets. But it can be any of those three if your intention aligns to that. And depending on how whoever is helping you to value the asset has valued it. Okay, so I will just leave it at that for now. All right, so that's a good question, fine. Any other one? Okay, guys, so if there are no questions, so I guess we can go and sleep. We are going to share this video tomorrow to your email directly. Then you can always watch it from there. Thank you very much. Have a wonderful night.
Thank you.
Thank you.
Thank you, sir.
Thank you, sir.
Yeah, bye.
Thank you, sir.
Yep.